Hello and welcome to our quarterly insurance price index for Q3, where I'll be looking at price movements over the past quarter, what this looks like over the longer term, and what we might expect for the rest of the year and looking forward to 2024. First, a little bit about who we are and what we do. At Pearson Ham, we help our clients succeed through better pricing, and we do this in several ways through developing pricing strategies, supporting with data and analytics, helping process and governance, doing price optimization, or proposition development and commercial model design. Market price tracking and benchmarking are also areas that we do a lot of work in for our insurance clients. In this area, accuracy and reliability of data is key to us. Also transparency and clarity of reporting so that our clients can make well-informed decisions based on the information and the insights that we're sharing. We're constantly investing in our systems and in our people to make sure that the services that we deliver are as good as they can be. Services are very much tailored to individual client needs and range from daily reporting right through to additional consultancy and support with implementation of some of the recommendations that are being made. Currently, we're active in motor insurance, home insurance and pet insurance, and coming soon will be travel insurance. So we're looking to launch market price tracking for travel in November. So if you're interested in that, please do feel free to get in touch and I can provide some more information on that. First, a bit on our methodology. We use a panel of real consumers who have given us their genuine risk details and permission to obtain quotes on their behalf. Every day we're running quotes through the big four comparison websites for motor insurance and home insurance, pet insurance, and we're gathering the prices and the details that come back from those quotations. We regularly refresh our panel members, but we always have an ongoing tracking of like-for-like price movements for the same individuals. We also have data cleansing processes in place to make sure that any anomalies are removed and what we report is an accurate reflection of price movements within the market. So we look at motor insurance first and see what's happened in the past quarter in terms of price movements. So it feels like I'm saying the same thing every quarter this year, but we've seen the biggest quarterly price movement since tracking began. So in Q3 2023, prices moved by just over 16% for the most competitive car insurance quotes. So these are the average of the top 5 prices that have been quoted on price comparison sites for the same batch of individual consumers. So we can see that there was a peak in July at 6.3% and price increases of 4.8 and 4.5 in August and September. So there is some leveling off and we can see that a bit more clearly looking at it over a longer term. If we look back over 6 months, we can see what that trend looks like. So over the past 6 months, we can see prices have risen by around 33%. So we can see that the rate of increases has come up, peaking in July and then slowing down a bit into August and September. So this means that prices have moved on a like-for-like basis by 46% over the past 12 months. So we're seeing an annual movement of 46% for the most competitive car insurance prices that are being quoted. So it's clear here we can see since the beginning of the year, the monthly price increases getting bigger and bigger up to July when they start to drop down again. So that's when I talk about a leveling off. The prices are still increasing, but the rate of increase is definitely slowing down. Going back even further, we can see that prices have moved up by 40% from January 20 to where we are now. So this is the pre-COVID environment. We see these price reductions coming in 20 and 21, a big peak in 22 following the implementation of the JIP changes, and then most of that price increase really flowing through in 2023 to reflect the increase in claims costs that are being experienced. So although the average of the top 5 quoted prices has moved by 46% over the past 12 months, it's interesting to look at it on a product basis. So this is a like-for-like basket of products that have been tracked over that same period. So these will be some of the larger, more established brands, and it takes out the effect of some of the new economy tiers that we've seen launched in the past couple of years. So much larger increases being observed here, up to 82% for the biggest mover on the left-hand side, and some of those kind of larger 77, 74% movements in there as well for some other brands. So an individual product level, quite sort of stark movements over the past 12 months. And these movements have been relatively consistent for those products where we're seeing the kind of the biggest rate increases over that 12-month period. So we can see actually in September, where we did see a slowing down of the rate of price increase, that actually some of these larger brands have actually continued and increased the rate of increase that has been put through. For that second tranche of products, so these brands that we've tracked, we can see actually they are starting to flatten out, and some have kind of reduced price. We see that insurer number 10 there at 22% on the previous 12 months has actually slowed down in September. And some of those other brands, again, we're seeing, if not a flattening, then certainly a slowing down of rate increase. So that's the picture on car insurance. So very large quarterly increase, year on year, big movements, 46%, some even bigger movements observed when you look at it at a product level basis. What's happening on home? So again, we're seeing the biggest quarterly increase since tracking began, and this is for combined buildings and contents cover on the same basis. So it's the average of the top 5 prices that have been quoted, so the most competitive rates out there for the same profiles each month. So we can see that the peak, again, mirroring motor of 4.1% in July, is followed by 2 months movement of 3% each. So just over 10% price movement for Q3 in combined. This means a price movement of just under 19% over the past 6 months. So significant price increases being observed. And again, we can see a similar pattern in terms of monthly price movements as observed in motor. So going back 12 months, we can see that over the past year, premiums for combined buildings and contents cover have increased by 33%. So this is on a like-for-like basis for the same profiles that have been tracked each month. So we can see a very similar picture to motor. So increases coming in from the start of the year, coming up, peaking in July, and then coming down again. These increases in August and September still significant, but slowing down a bit based on what we saw previously. Again, looking at a basket of like-for-like products, we can see some more significant price movements being observed here. So there's one particular outlier on the left, which has moved up by 96%, but there are some others which are above the average of the top 5. So again, this is looking at like-for-like products, so the same brands, and takes out the impact of some of those economy tiers that have come onto the market more recently. So looking at this monthly, we can see what's driving some of those large movements, in particular the 96%. So it looks like some corrective action was taken in July, and there's been some recalibration over the past couple of months following that. So it's less of a consistent increase, but more something that's obviously been done in response to profitability challenges. For the next tranche of products, which have moved between 18 and 37% over that 12-month period, we can see a bit more consistency. And also we can see that pattern where the biggest price increases have ramped up through June, July into August and have started to slow down a bit more recently. So in September, we can see some flattening out of some of those rate increases, or at least the rate of price increase slowing down. For contents only, we are also seeing the biggest quarterly movement since tracking began, and also seeing a similar pattern where the rate of increase peaks in July and then slows down a bit in August and into September. So we've got around 8% price movement for Q3 for contents only. Looking back over the past 6 months, we can see that Q3 is a significant uplift on the previous period. So over the past 6 months, prices have moved by 10%. So bearing in mind 8% of that happened in Q3. So much lower price increases being observed in Q2, but coming up again as we've come into Q3. The 12-month view here for contents only, so slightly different from what we've seen on car and combined cover. So that Q2 being the bit of the outlier. So we've seen sort of large increases towards the end of last year and into the beginning of this year. Those increases slowing down a bit in Q2, but picking up again in Q3. So slightly different picture that we're observing here compared with the other two markets, but similar level of increase. So as I say, it's the biggest increases that we've seen since tracking began. Taking a similar like-for-like product view, we can see there have been some significant price movements which are kind of masked by the average movement that's been observed. So up to 68% at the left-hand side. And again, looking at this monthly, we can see what's been driving some of that. So this is the same provider that we saw previously for combined cover. So in July, what appears to be corrective action being taken, some recalibration following that, which is resulting in the large increase that we're seeing here. Some more consistent changes for some of those other products that sit below this one. In the second tranche of products, where we're seeing movements between 5 and 26%, again, there's more consistency here. So they've been coming up since the beginning of the year and have continued to do so into the last quarter that we've observed. So what can we expect to see for the rest of the year, and what does 2024 hold for us in terms of insurance price movements? So this has been an unprecedented year in terms of rising insurance prices. Lowering of premiums during COVID took them to an unsustainable level, and this has been further exacerbated by soaring prices and labour shortages more recently. We've seen insurers reporting the worst figures in a decade, and some providers pulling out of the UK motor market. EY reported an industry COR of 109.5% for UK motor insurers in 2022, and are predicting further losses in 2023. So it's clear that premiums have had to rise. Recent figures from the ABI provide a bit more detail on this. So we've seen a huge increase in the amount being paid out in claims, up almost 30% on 2022. But it's not just claims costs that have increased. We've also seen an uplift in frequency since last year. So a reduced volume of claims has been something which has to an extent mitigated the rising costs, so that it's an important one to watch. Cost of vehicle repairs has leapt up by 46%. So this reflects energy inflation, the cost of parts, labour rates, more expensive repairs with new technology coming in. Labour shortages and longer repair times are increasing the cost of replacement vehicles, which often have to be provided for longer than had been anticipated or factored into the prices that have been charged. And we've also seen a huge increase in payouts for vehicle theft, in part driven by increases in average price of second-hand vehicles. Auto Traders reported a 28% increase in the cost of second-hand cars between April 2021 and June 2023. So that's having a significant impact on the amount that insurers are having to pay out. On a more positive note, we may be seeing some benefits from whiplash reforms. A drop of 6% between Q1 and Q2 in the amount paid out for personal injury claims translates to a year-on-year figure of -8%, so 8% less being paid out for personal injury claims in Q2 this year compared with 2022. So some of these factors are also influencing home pricing. Cost of materials has massively increased. Labour shortages are resulting in similar delays to repair or rebuild. We're also experiencing the impact of climate change and more unpredictable weather events. So these have already caused challenges for home insurers and are likely to continue to do so. So it's a difficult time for insurers. The pressures which caused such negative results in 2022 appearing to get worse this year. So how is this likely to develop, and what does it mean for general insurance pricing? Well, we are starting to see inflation falling. So falling gas and electricity prices have provided the largest downward contributions here in July, and that's largely based on the lowering of the Ofgem price cap. We're also seeing reports of food prices falling, and this is for the first month in 2 years. So again, this could indicate a more comfortable environment for insurers. We're also seeing the value of second-hand cars flattening out. Although the average asking prices remain fairly high, they haven't increased much further recently. Again, this is potentially welcome news for motor insurers. However, there are still some trends which we need to be monitoring closely. There's been a lot of talk about people returning to the office and firms requiring people to come back in for at least 2 or 3 days a week. And the Department for Transport car usage figures appear to show that this might be having an impact on the road usage. So over the past few months, we've seen car usage exceeding pre-COVID levels, and as reduced frequency has been somewhat of a mitigating factor in terms of rising cost of claims, this is definitely one that insurers need to be keeping a close eye on. So what does this mean for the rest of the year? So this is the picture for motor insurance. As I said earlier, we've seen the biggest increases that we've seen since tracking began in Q3, and it does look as though the rate of increase is slowing down. So I don't think we're going to see any price reductions, but the rate of price increase has slowed down slightly over the past few months. So I'd expect to end the year somewhere between 47 and 57% higher than the start. So significant price movements, really unprecedented for motor, but I think things may be starting to slow down a bit. For home, buildings and contents cover, I'd expect to see a similar picture. The rate of increase slowing down and ending the year somewhere between 33 and 39% up on the previous year. For contents only, a similar trend. The magnitude of change not quite as great, but ending the year somewhere between 20 and 24% higher than the previous year. So what to expect in 2024? Well, trying to predict how pricing might move in this market over the past few years has been almost impossible, and next year is no exception. Dare I say it, though, we may see some stability creeping into the market. In January, it will have been 2 full years since the ban on dual pricing initially rocked the market. Insurers have gone through a couple of renewal cycles and should have a grip now on how to price for new business and renewals. We've seen pricing revert following the premium reductions driven through COVID and the lockdowns. Premiums have also moved up in response to the huge increases in claims inflation caused by increasing cost of parts and repair delays due to the labour shortages that are being experienced. We're also seeing some of the inflationary pressure easing, or at least premiums could be at a position now to cover the cost of claims being paid out. Increasing claims frequency is an issue, and as more people return to the workplace, it's a concern and certainly one that needs to be monitored closely. On balance, I expect price increases to flatten out in the new year in what feels like a new competitive landscape. Average premiums may reduce in the new year as they do seasonally, but I wouldn't expect to see any material price drops until insurers are more comfortable in the new environment. So likely to see some stability through the first half of the year, and then depending on if and how costs change, we may see some increased competition and prices starting to drop. It does feel as though we're at the peak of the pricing cycle, which is inevitably followed by a drop. It's just a case of when. If you'd like any more information on our services or would like to discuss any of the points raised during the webinar, then please feel free to contact me directly on stephenkennedy@pearsonhamgroup.com, and I'd be happy to answer any questions that you may have.